Perfect. Okay, thank you. Good afternoon. My paper is titled The OECD BEPS Action 1 as it pertains to tax administration and tax policy. I'm basically looking at tax challenges of digitalization on tax administration in a few countries in the Southern African Development Community member states. I should indicate that I'm not the reason why, let me just say, the reason why I chose a selected countries is due to the fact that it was difficult to find information from other countries. So I thought I should just start with 3 countries where information could be available so that the study could be focused. The paper is really has been influenced by the fact that digitalization, as it has currently been now the major aspect of taxation all over the globe, has brought with it both benefits and disadvantages. My approach relates particularly to the challenges and disadvantages of digitalization, particularly on tax administration of developing countries, which are already struggling with the current administration of even the traditional tax law policies as they are. So I found that this particular new approach is also imposing further challenges and more burden on already struggling tax administration. So that was the aspect of what I wanted to look at and see to what extent probably I could share with you in this particular conference. Digitalization, as we know, has allowed businesses in many sectors to locate various stages of their production processes across different countries, and at the same time access a greater number of customers around the globe. So that's a positive aspect of it. And it has also allowed some digitalized enterprises to be heavily involved in the economic life of a jurisdiction without any or significant fiscal presence, and that somehow causes some challenges to tax administration in particular. The broader tax challenges of the digital economy are found both in the direct and indirect taxes. So these are not only confined to any specific type of taxation. As far as direct taxes are concerned, particularly, it has become very, very difficult under the current international income tax rules for jurisdiction to have minimal or no rights to tax any companies or such companies if they probably either maintain a small or sustained economic presence in a particular jurisdiction. So this has been the fundamental challenge arising from digitalization in respect of indirect taxes. As far as direct taxes, as far as indirect taxes are concerned, for example, as mainly on VAT, the difficulty of collecting VAT or GST in the destination country, where goods and services and intangibles are acquired by private consumers from suppliers based overseas, which may have direct or indirect fiscal presence in the consumer's jurisdiction. So this has also caused a lot of challenges to collect the VAT that can be due or that should be collected from this type of services. Furthermore, the ability of some businesses to earn income from sales from a country with a less significant fiscal presence in the past, thereby calling into question the relevance of existing rules that look at fiscal presence when determining tax liabilities. So these are more or less the challenges, and this has been identified particularly by the OECD, and they are also contained in the international VAT guidelines. So basically, the main challenge or the question that arises in or as a result of digitalization and also a digital economy and the challenges thereof. The broader tax challenge basically is the question of how taxing rights on income generated from cross-border activities in the digital age should be allocated among countries. So because of the nature of the countries that I'm looking at specifically, they are part of a sub-regional organization, and they have achieved to some extent some kind of cooperation, some kind of harmonization in terms of broader trade laws and customs and duties. However, as far as the other type of taxes are concerned, this has not been achieved. So this by itself also adds more or imposes more challenges in this specific type of countries that are situated in the Southern Africa. I'll just basically just highlight, but in the paper there is more detailed on the nature of digital economy and the features of digital economy as for purposes of making a connection and trying to develop the argument further as it is. We know that the nature of digital economy by itself can be mainly some or aspects or supplies or even trading activities that are intangibles, and therefore they can be difficult to be traced by the tax administrations. And furthermore, most of them are carried on the e-commerce platforms as they are. They can either be in the form of digital services or even digital goods, telecommunications, software, or games or online gaming, and so on and so forth, as it is. So therefore, they sometimes and most of the time, the multidimensional business models which occur or which underline the digital economy itself can be difficult to be traced by the tax administrations. This can either be particularly in indirect taxes. So that kind of a feature by itself it creates challenges for tax administration. Furthermore, even payment services themselves, as part of the main business models of digital economy, the buyers and sellers can provide intermediary services or credit card envelope or even bank transfer services, which may not be so easily traceable, which means other third parties have to be involved or have to be incorporated in trying to trace the nature or even the flow of this type of models of business as they are. So that by itself requires some kind of technical resources to be able to trace those kind of transactions as they are within a specific jurisdiction. So if we imagine the developing tax administrations which are not coping, even dealing with the manual type of tracing of taxpayers or even transactions to follow them up, that can be problematic in that way. So as far as the Action 1 of BEPS requires, it requires the OECD to identify the main challenges that the digital economy poses for the application of current international tax rules and develop reforms to address these challenges, both direct and indirect taxation. And it is clear, therefore, that the OECD driving this project must work together with the various tax administrations around the globe. So in my view, at least, as the interest of continuing this particular research was to look at what digital economy poses, or what kind of administrative challenges digital economy poses to this tax administrations. According to the OECD, the digital economy has become the tax-based erosion and profit transfer disaster area. So digital economy, it is described by the OECD, has weakened the link between economic activity and specific location. So it can be very difficult to identify where the particular service has been rendered or where it has either been consumed in either way. Therefore, the impact of digitalization on tax policy and tax administration within the Southern African Development Community countries, member countries, is taken from two perspectives. That as far as and also confirming the view of the OECD, that digitalization is offering new opportunities as well as some challenges to tax policy administration beyond the international tax system. I think this is the approach as well that the developing countries, particularly within Southern Africa, has actually embraced the digitalization or digital economy. However, they've got their own challenges. They're already struggling with effective tax administration in respect of traditional methods of taxation. So most of the SADC countries have not yet, for example, modernized the tax administration. They lack personal resources to engage in effective tax administration. They also further lack sufficient funding, which just is an indication of the government's not really committed to advancing or to modernizing the tax administration. So that also becomes another burden on the tax administration. And furthermore, what we see, which is quite which is something that is very, very clear, is the lack of advanced ICT technologies that can track the source of the digital economy transactions. I think this is a huge challenge as far as tax administrations are concerned. So for purposes of this paper, in just trying to provide a brief background, is that these particular countries, they, as far as they try to align with the OECD and try to also implement the BEPS Action 1. At the regional level, the African Tax Administration Forum has taken a leading role in trying to implement international tax rules. And these countries also are part of the African Tax Administration Forum. So apart from the BEPS Action 1, the African Tax Administration Forum was also convened, set up its own requirements as far as how this particular rules should be implemented and how the countries should approach digitalization or digital economy and the tax administrations as they are. So at the regional level itself, there are further rules, and there are also other tax policy approaches that have been adopted. There are various instruments, the Protocol on Finance and Investment, and the Memorandum of Understanding on Cooperation in Taxation, SADC Agreement on Assistance in Tax Matters, SADC Model Tax Agreement, and SADC VAT Guidelines. However, all these instruments that exist, none of them has actually given a clear mandate on how the member countries should approach the tax administration as far as digital economy is concerned. And even to mention further, some of these instruments are not yet implemented. So there is this body of instruments, there's this body of agreements at the regional level, which also imposes certain requirements as far as the either harmonization or even coordination of tax rules at the regional level. However, they do not specifically deal with the issue of digitalization or the digital economy. One would argue that perhaps some of them were adopted prior to this development, but some of them are recent instruments instruments, and some of them have not yet even been implemented. So it could be easy to try to see. But however, the other question that one needs to pose is whether this underdeveloped or developing countries have the capacity to implement so many rules and regulations at the regional level and try to align their own domestic legislations with this regional organization. So that is another, I think that's another huge challenge in as far as these countries are concerned. Apart from those more or less general instruments, there are also bilateral agreements between the member states themselves. And I've chosen the specific ones because I'm focusing my paper with these 3 countries, which is Lesotho, South Africa, and Eswatini, which was previously known as Swaziland. So these countries have various bilateral agreement for the avoidance of double taxation and the prevention of fiscal evasion with respect to taxes on income. And the two are more or less, they are similar between the one adopted between Lesotho and South Africa and Eswatini and South Africa. They have similar provisions, but for different countries. They also have bilateral agreement on value-added tax and issues of how the refunds will be done. And this agreement are also signed between South Africa and Lesotho and South Africa and Eswatini. So apart from the other, those regional agreements, there are also these bilateral agreements, which one could argue that they can be more relevant on issues of digital economy and how tax administrations can handle the issue of digital economy, because they are more focused on specific countries. However, because these agreements were, they've been they have been implemented for a couple of years now, they do not really specify. Probably they will need to be relooked by these countries and try to see how the issue of digital economy is infused within the agreements themselves. So there is a whole body of these legal instruments that these countries are party to, or are parties to, but most of them do not really provide any guidance on the issue of tax administration or tax policy as far as digitalization is concerned. And I think that's also another loophole or another challenge that actually impacts on the effective implementation of the effective implementation or infusion of the OECD BEPS 1 into this particular region and how it is effectively implemented. According to the African Tax Administration Forum, the countries, particularly these African countries, depend on tax to drive domestic revenue, mobilization, and finance the national budgets. So to achieve these 2 objectives, revenue administration are mandated to collect revenues in an efficient manner. Reforms in tax administration form a crucial component of the drive to enhance efficiency in revenue collection. So even at the African regional level, does confirm that tax administration is crucial for purposes of effective implementation of whatever laws or of that these countries have to implement. And the areas of tax policy which are quite crucial for purposes of improving or achieving effective administration in these particular 3 countries, South Africa, Lesotho, and Eswatini, composed of that maybe they look at the change or the review of the tax policy in general, particularly in respect of trying to uphold or to understand the challenges of digitalization or digital economy and what it brings to the traditional tax laws. Organizational structure of tax administration, that's quite crucial, because as long as the structures of the tax administrations themselves do not do not portray the fact that they are actually paying attention to the digital economy, which seems to be a very important aspect now, and also it affects a lot of economies. So I think that could be also a problem. So that is also significant. And also ATAF recognizes that the core functions of tax administration should be clearly aligned within each particular member state, and for purposes of achieving effective or efficiency in tax administration. Furthermore, management aspects and resources of tax administration. Tax administration should be well resourced. They should have manpower. They should have ICT and a lot of other tools that can actually assist the management and the tax administration offices in general. As much as I've highlighted mainly, that there are more challenges, particularly to issues of to what digitalization brings or comes with in as far as the existing tax laws are concerned. There are good practices in certain aspects in these particular countries, South Africa, Eswatini, and Lesotho. And South Africa is quite advanced within this group of states, because they have actually more or less achieved a modernized type of tax administration, and due to also their economic status, even their offices, the South African Revenue Service is more equipped, and it has, at least to some extent, achieved issues of staffing, of more personnel. Also, issues of ICT have also improved in one way or the other. It's not only South Africa, and it has also improved its compliance management evaluation system. So that is a good thing, because then it means that South Africa can be able to take up the issues and the challenges that are brought by digital economy. Even the enterprise risk management in South Africa, from the recent research of 2018 to 2019, it is shown that they have improved their enterprise risk management. On the other hand, Lesotho as well has enhanced its own audit function for large taxpayer compliance. So at least there have been some kind of improvement in trying to make sure that they enhance their tax administration. So that has also been very good, and it has been achieved since 2014. Eswatini, on the other hand, has also been able to incorporate the use of social media in their taxpayer engagement programs. So that is also significant in trying to promote its own compliance campaigns and taxpayer feedback to increase coverage of at a lower cost. So there have been some good practices or some good stories, but I think there are more challenges, and they need to concentrate on that. The challenges basically in more detail. 5 minutes.
I'll just ask you to wrap up, because we're just about to run out of time. So if you could just wrap up in 2 minutes, that would be great.
Okay, thank you very much. So what I've identified is that the BEPS rules themselves, particularly Action 1, which is the concern of this paper, is the rules are complex, and therefore in some of this tax administration can actually struggle into what they are supposed to do. Lack of resources in revenue authorities, I've already mentioned that. Tax enforcement is costly, particularly audit mechanisms, which can help in trying to ensure that the tax administrations perform to what they're expected to do. Furthermore, I think there's need for simplified registration procedures, particularly for those businesses that operate online or on e-commerce platforms. So that's the various countries have to concentrate on that. And also they need to invest in retraining retraining the tax officers to equip them with the necessary tools to address the challenges of digitalization and also to achieve capacity building. And in conclusion, I think that the concerted effort amongst the SADC countries to work together and exchange information, particularly because they already have an instrument on exchange of information in tax matters, that will also be able to assist them to implement laws and regulations that will tackle the digital economy, and also to achieve simplicity in developing new rules regarding tax and rights in the digital economy transactions. Thank you very much.
Thank you very much for a great talk. Sorry that I had to cut you off at halfway, but we were sort of running a little bit out of time, and we have a really packed program today. So,
okay. Thank you.
Does anyone have any questions? We still have a few minutes before the next speaker. Sorry, I'm just doing a bit of multitasking and checking the chat function in the Zoom call. Oh, okay, now I can see everything. Okay, so
I think one of them was just a comment, just that I should put up my full screen, which I missed. So I don't know if they manage.
I think we have a comment about how is South African government trying to protect the revenue from digital economy?
Okay. South Africa adopted new provisions in terms of that the business entities that enter or that do transactions in South Africa with particularly customers, that the registration threshold, those who do over 50,000 rand transactions in South Africa with other entities within South Africa, then they need to register. But then the proxy or the requirements would be that they should have used a bank account in South Africa as it is. So they are able to pick that up if there has been a transaction through the bank. So that particular requirement, I think, has made the rules, or more or less the efficiency of trying to protect the revenue from digital economy a bit better in that particular respect. However, I think there's still room to improve and even to tighten the net further. But the most unfortunate thing is, as much as South Africa, because it is a bigger economy within these member countries, has done so, the other countries do not as yet have those kinds of rules within their own domestic tax policies. I hope I have answered the question.
Thank you very much.
Thank you.
One more question, and while I ask this question, if I could ask the next speaker just to get the slides ready. So while the next speaker, one more question: do you think tax digital payments made to test authorities? I'm not entirely sure I understood the question, but
me too.
Do you think tax digital payments are made to test authorities? Like TOEFL or GRE?
Maybe they. Do you tax digital payments made to test? I mean to say, do you tax digital payments made by SA citizens? Those are treated like any other transactions. If a taxpayer is a South African citizen, so those will be treated like all the other types of transactions carried in a normal way. But also, I mean, but But I think the issue would be whether the South African Revenue Services can be able to trace that. But because the payment would have been made, for example, from a bank in South Africa, then banks are mandated to disclose the information to the tax administration authorities.
Okay, perfect.
Thank you.
Okay, and the last speaker on the session before we move on to our panel is George Turner, presenting What Gets Measured Gets Done. So if George is...
Hello.
Hello, here you are. Thanks for coming. Whenever you're ready to share your screen and to start the talk, that would be great. Feel free to take over. The floor is yours. As usual, 20 minutes for the talk, 5 minutes for questions, and then a little 5 minutes sort of group.
Okay, yeah, I am slightly trying to work out how to do this, but I will find it in 1 second. Hold on. The issue is that when I start the presentation, it takes over my whole screen, and then I can't do the share screen.
Are you a Windows user or a Mac user? Because you can Alt Tab it.
I'm the horrible Linux user.
Oh, I'll stay out of that one then.
User. Okay, so hold on. I will.
So while you're fixing your presentation, just a quick announcement that next talk will be the panel the panel discussion on COVID-19 and its related impacts on gender, in particular on women. So please stay on for that one. So, but before we go there, I'll leave the floor to George Turner from Tax Watch.
Does that work?
It's yours.
Can you see this presentation?
Yep, all good.
Okay, great. Okay, look, thank you so much for inviting me here to speak. And I'm going to start off with a huge apology in the sense that I'm the most that disorganized person who, even though this conference was scheduled for the summer and papers shouldn't have been in kind of last year, still didn't manage to get it done. But my only excuse is I've had a child in the meantime. So this so a small person is knocking around, which is distracting stuff. But what I wanted to do is talk about the issue of how HMRC measures its performance in terms of tax compliance. And I'll go into a little bit more about why we thought this was a good idea in a second. But firstly, I want to tell you a little bit more about Tax Watch, which is the organization that I work for and run. Because I guess we're a slightly outlier in this conference, in the sense we're not an academic institution. Tax Watch is a kind of relatively new organization. We were founded in 2018 by Julian Richer, who's a hi-fi sales entrepreneur, owner and, well, no longer owner, but previous owner of Richer Sounds. He sold the majority of it to his employees last year. And Richard Brooks. Richard Brooks is an investigative journalist, works for Private Eye, but previously was an HMRC tax inspector working in the field of international tax. So you may have read his book, The Great British Tax Robbery, which goes into these issues. And at the end of that book, he says maybe someone should start up an organization like Tax Watch to do this. And Julian read it and said, let's do it. So that's how it happened. We're a UK charity. Our purpose is to promote compliance with both the letter and the spirit of the law. You know, we think that's an important thing. And clearly, tax avoidance fits squarely in that, given that the very definition of tax avoidance is by HMRC is something which meets the letter, but perhaps not the spirit of the law. We do things slightly differently than a standard think tank. We pose ourselves as an investigative think tank, and we're truly of the belief that, you know, a lot of these issues can't really be discussed properly without sufficient detail of how things work in practice. So, you know, it's very well talking about policy issues on a theoretical level and looking at economic phenomena and benchmarks, etc. And all of that I find very interesting, but I also think there's a lot of discussion around the issue of tax avoidance in particular that kind of almost talks at cross purposes to how these things really work on the ground. And what we try and do is present reports which go into detail about what schemes are, how they work, how they don't work, etc. And with the idea of providing that research for the public benefit. So we started looking at the issue of measurements. I mean, we're interested in the tax gap in general, obviously, just to see how big a problem it is. But we kind of started noticing that if you look at budget announcements made by the UK Treasury every year when there's a budget, although we've stopped having them in the last few years, usually there's a budget every year, and in the budget there'll be policy announcements, and usually there's figures attached to most policies, and we started to ask what has been the impact. Looking back at tax policy announcements made from a few years ago, could you look back at those policies and say, well, did they work? And that was the thinking behind why we started looking into this area. Now, I think the context of this is that you all know this stuff. Tax is a matter of prime public interest in government action, and it has been for 10 years. In the public eye. We had the global financial crisis in 2008, and then The Guardian published their tax gap series in 2009, which was like 2 weeks of wall-to-wall coverage on tax avoidance. People in rival publications at the time thought that The Guardian was mad, that nobody would find this issue of any interest, tax is boring, blah, 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 but how wrong they've proved it to be. In the meantime, we've had LuxLeaks, Panama Papers, Paradise Papers, Swiss Leaks, and the list goes on and on and on. There's, on a political level, you've got the Locarno Declaration, not in 2018, in 2013, I believe, leading to the BEPS process, and European Commission investigations. It's been one of the stories of the last decade. And as a result, when you look at opinion polls, the public frequently cite tax avoidance as one of their biggest concerns, and they are entirely against it. So this leads to regular calls of politicians to do more, and so on. And all of that has led to HMRC placing more of a focus or an effort on describing how they combat tax avoidance. There's pressure on HMRC as the tax authority, given what's happening in the public sphere, to talk about what they're doing to combat tax avoidance and tax evasion more explicitly. And so what we looked at is is a set of HMRC objectives, which are published every year as part of the HMRC annual report. In previous years, there was this performance report that HMRC point, and they had the objectives in that. But up until, but in more recently, it's all been included in the annual report. And these are the top three objectives of HMRC in each year for the last 3 years, and you can see they're very similar. I mean, they're always the same, but the top one is maximize revenues due and bear down on avoidance and evasion. And interestingly, this is relatively new. You might think, oh, the tax authority has always thought that tax avoidance and evasion is an important problem to deal with. But 2017 was the first year that this phrase, bear down on avoidance and evasion, appears in the headline of these objectives. In previous years, the target, the first objective, was simply to maximize revenues. And there was obviously, reference to avoidance and evasion within the text of the objectives. But having it in the headline, I think, is a significant statement from HMRC, is saying that we are really focused on this, and we want to tell people that we're focused on it. So when HMRC set out these objectives, they also have these KPIs, or key performance indicators. And alongside the objective of collecting tax, so, I mean, interestingly, you will note that in 2019, it changes from maximize revenues to collecting revenues due. I don't know what the genesis of of that changes, but perhaps somebody here knows. And they have several key performance indicators. So you have the total increase in tax revenues, the additional tax generated by tackling avoidance, evasion, and non-compliance. That's really the compliance yield. There's the level of fraud and error in tax credit system. That's a KPI that will gradually be diminishing as new tax credits claims have stopped being taken. And there's the UK tax gap as a percentage of the total tax. This is what the KPI. And total revenue protected or generated by tackling organized crime. And then there's total number of criminals and fraudsters successfully convicted. Now, in addition to these headline numbers, they also have a section which is their public commitments, and they benchmark their public commitments, or they rather look at the progress towards the public commitments in a traffic light system. And there's a large and much larger number of these, but these are the ones I picked out as being relevant to the avoidance and evasion part of the objective, rather than the simply maximizing revenues part. And they are maintaining the overall long-term downward trend in the tax gap over the past decade, delivering compliance revenues of 34.5 billion, continuing to invest 800 million in additional work to tackle evasion or non-compliance in the tax system, raising an additional 5 billion a year by tackling avoidance and aggressive tax planning, evasion and non-compliance, and by addressing imbalances in the tax system, and then working to tackle the hidden economy by developing options for legislation to make the renewal of some public sector licenses conditional on the applicants being proportionally appropriately registered for tax. I mean, I'll go on. And I think the thing to note here really is actually, interestingly, this is kind of a mix of quite specific policies, some operational things, and also going targets against the KPIs and the numbers, the compliance revenues, the tax gap, for example. And there doesn't really seem to me to be a huge amount of coherence to this list, because clearly this is not the only things that the HMRC do in terms of their policy areas, but these are the ones they've chosen to highlight for whatever reason. It's not clear to me exactly why, for reasons I'll come on to in a second. Now, and I think what it also shows is that, if you look at really what they're trying to kind of benchmark their main efforts against is really the compliance yield and the tax gap. The other measures on here are relatively specific, and if they're not specific, they're things that really, continuing to invest 800 million in additional work. Well, if the Treasury gives HMRC 800 million, it would be an abject failure if they then didn't just spend the money. I mean, it's not exactly the hardest public commitment to meet. I think really they're kind of, what this shows through is that on a big picture level, they're just looking at compliance gap and compliance yield and tax gap. Now, if we look at the tax gap is a broad estimate of all tax losses arising from non-compliance, error, and fraud. There's a significant amount of estimation required. Methodological changes have taken place over the year, and they've led to large reevaluations of the figures. And over 20% by value is comprised of experimental methodologies. The Public Accounts Committee recently did a report on the tax gap, describing the figures as highly uncertain, suggesting they should come with some sort of health warning. And key is that they don't really include BEPS effects. HMRC are quite explicit about this, in the sense that profit shifting by multinational companies, i.e. what the BEPS process is designed to combat. I mean, in previous years, HMRC have been quite clear that this is not included in the tax gap. There's been some criticism of that. And now they're kind of a bit more ambiguous about what is and what isn't included. So now there's talk about, well, profit shifting that is unlawful is excluded, or is profit shifting which is just sophisticated tax planning isn't included. It's not clear at all where the line between those two things are in terms of what HMRC regard those things are. But what is clear is that if this is being used as a kind of key benchmark performance measure in public-facing documents about how we should measure the performance of HMRC, if you speak to most people in the street, you stop somebody outside Exeter Cathedral and say, talk to me about tax avoidance, the first thing they'll say is Google, Amazon, Starbucks. They won't talk about disguised remuneration necessarily or other forms of tax avoidance. And so the issue that the public probably most care about is largely not included in the tax gap. That's a real issue if that is going to be one of the key benchmarks to measure performance in that area. The compliance yield has, many of the same issues. Compliance yield is not just cash collected. It's not simply HMRC going and getting cash in from various things. It includes things like called a future revenue benefit, which is looking at, because I caught somebody doing something today, it means they're not going to do it in the future. So I'm going to include that in my compliance yield estimates. It includes things like upstream processes, things like where they make it easier to fill out a form and therefore leads to fewer errors in completions of that form. That will be included in compliance yield as well. All of this, again, is highly uncertain and significant amounts of estimates needed. Now, this is the components of the compliance yield as set out by HMRC. And the gray bars at the bottom are cash expected. And you can see it's a minority of the total compliance yield figure. You've got product and processes yield. You've also got accelerated payments in there. Future revenue benefits is a substantial chunk, as is a revenue losses prevented, so not actual losses that have taken place. So, the question we kind of looked at is, could we get more granular? And you easily could, I think, because HMRC publish, and this is again part of their efforts to be more upfront about what they're doing in this area. They publish a document. They publish a document called "Tackling Tax Avoidance, Evasion, and Other Forms of Non-Compliance." Again, I've got the date wrong. It's 2019. If I circulate these slides, I'll update the errors. It says in it, this government has introduced over 100 measures to tackle tax avoidance, evasion, and other forms of non-compliance since 2010, which, alongside HMRC's compliance work, have secured and protected an additional 200 billion in tax revenue, which would otherwise have gone unpaid. Now, again, and this was included. They had a list of all 100 measures in the annex of this document called Annex A. So we wanted to find this 200 billion figure, by the way, is cited all of the time by politicians in Parliament. It was actually cited in the Conservative Party manifesto for the general election last year. So a considerable amount of importance is placed on that 200 billion pounds figure. We asked HMRC what it's actually comprised of, and they said the 200 billion in additional tax revenue mentioned in the publication reflects our overall compliance activity and is not solely the result of the measures listed in its Annex A. There are also some measures included in Annex A which do not contribute to the 200 billion figure, but do contribute to overall tax receipts. The following diagram explains the components of each. There's a diagram they provided. So you see here they have legislative changes that raise additional tax receipts. That's not included in the 200 billion pound figure. Operational measures, product and process changes, and all other compliance activity. And those three things are included. So the 200 billion figure, again, is really just an amalgamation of the compliance yield over a period of 10 years. Again, reinforcing the fact that the compliance yield in aggregate is really the most important figure, or one of the most important figures they're using, in a figure that is being targeted. However, when you look at a lot of those, as I said at the beginning, you look at a lot of those policies, they do have policy costings attached to them. We started looking at this issue because there was a policy of naming and shaming. This was brought in 2016 budget, naming and shaming companies, large multinational companies with poor records in tax compliance. And that, together with the with the obligation to publish a tax strategy was scheduled to bring in about £600 million a year in the budget. And we asked HMRC what evaluation they had done of that, and whether it had raised that much, and we found that no evaluation had been done. Now, we decided to look at a couple, just by way of example, I thought two very specific areas, which I'll canter through. Landlords. Now, we know that landlords and people not declaring property income is a big problem. It's very easy to do. Simply collect the rent in your bank account, don't stick it on your self-assessment tax return. I think research by Dr. Aaron Advani, formerly of this parish, talks about 30% of landlord income just not appearing on self-assessment tax returns. In 2013, HMRC puts this together the Let Property campaign, which was designed to combat 500 million of tax evasion in the private rented sector. The idea was they would send out letters to people who they thought weren't declaring income. And in 2019, FOI requests showed that only 2.3% of people had made voluntary disclosures under that program, 2.3% of people that HMRC had identified as potentially problematic. And we estimated that tax evasion in the private rented sector could be as high as 1.73 billion this year, or in the last year. So see, clearly this policy has a long way to go. Another area is online VAT fraud. Now, I won't go back, but in the list of public commitments, there was something specifically about online VAT fraud, which was this joint liability legislation. And this was basically saying the big problem with online VAT fraud is people setting up in China or somewhere else, going on Amazon Marketplace, setting up a shop on Amazon Marketplace or eBay, selling and then just not declaring the VAT. And then if HMRC ever try and find them, they just disappear. And so there was legislation brought in to put in joint liability with the platforms for the VAT bill. And this is specifically cited in HMRC's public commitments in 2020. Now, figures suggest that a VAT fraud just in the online sector, just this online VAT fraud, is up to 1.5 billion a year in cost. Now, HMRC claimed that the joint liability legislation brought in 2016 has brought in an extra 585 million over 3 years. So clearly, that's a significant amount of money, and it's a good thing that they did it, but, it still has a long way to go. So I guess my overall conclusions and the point I'm making here is that if you look at the main performance measures that HMRC state in their publicly facing documents about how they should be measured, their KPIs, the tax gap and the compliance yield are unsuitable for meaningful benchmarks in terms of measuring real progress for a number of reasons. We also know that policy interventions are frequently focused on specific areas of non-compliance. So why not just measure the progress of specific policies against targeted areas of non-compliance? To go back to that example of online VAT fraud, HMRC know, or they have estimates of how much tax they're losing through online VAT fraud. So why not take the basket of policies they put together to tackle online VAT fraud and measure progress of those policies based on the total level of VAT fraud, online VAT fraud. So, matching the policy target to the policy problem. And by doing this, I think, the problem with the tax gap and compliance yield, although it's broken up in the tax gap documents, it doesn't provide that level of granularity in order for the public to make those assessments. So it would probably be a much better way of presenting progress to do it on that basis, on the basis of looking at specific areas, targeting and looking at policies and their progress towards that. And also, that could be a way of engaging Parliament and committees and the public and so on, looking at what public priorities are and setting them out in a more meaningful way. So hope that was of some interest, and I hope I haven't gone too far over the time, and I happy to take any questions.
No, you're perfectly on time. I think we can open the floor for questions. So one of the people in the audience, Guy Mully, mentions regarding your good point about testing tax policy, an excellent paper at TARC 2019 by Nick O'Donovan, examining the effect of corporate tax policy. Just to point that out in case you're not familiar with the paper. So a question from the audience, tax gap, how much tax gap has been reduced in the UK over the years? Your take on it?
So I don't actually have the figures to hand. I mean, I think where the Chief Secretary to the Treasury earlier this year said it was, in a very highly political statement, said it was 7% under Labour and 5% now under the Conservatives. And so there has been a long-term downward trend in the tax gap as measured by HMRC. But, you know, as I highlighted in my presentation, what it measures is highly contentious. You know, the estimates for how much the UK loses to profit shifting by multinational enterprises are very broad. You know, I think there was a paper by the University of Oxford which estimated up to £25 billion a year. Tax Justice Network this last month just put out something which I think was in the region of 8 billion. And so, but, you know, if you look at that perspective, the tax gap is around 35 billion a year as measured by HMRC. So if you added these other things, it could change by a huge amount. And I think the other point was that, you know, if you look at I think only around 40% of the various measures that make up the tax gap have bands of uncertainty, i.e. in the data. And you look at the kind of lowest and the highest points of them, you know, it suggests the tax gap is in a range of around, I think, 7-8 billion or so, you know, which is a third of the total. So it's a problematic figure when you're looking at those kinds of trends, I think. And I'll definitely read that paper from the last year's conference.
Thank you very much for the fantastic talk.
Okay, well, thank you very much, everybody, for sticking around for my talk. My name is Stephen Daly, and I'm a lecturer in corporate law at King's College London. The title that I've given this is Priority Setting in Tax Administration. Now, because I appreciate that I've kind of gotten the graveyard shift here, and because I appreciate that everybody's absolutely exhausted and is just waiting to get along to the celebration of Lynn Oates, and then also finally Judith Friedman's excellent talk later, I've tried to make this a little bit lighter. So I have used a lot of pictures in my slides, and I've used very little by way of text. So let me first then, with that in mind, set the scene. You'll see there on the left-hand side of the PowerPoint that we have a lovely scene. We've got leaves on the ground. We've got a bridge, possibly over a stream, possibly over some kind of a river, who knows? And in the background, we've got some more nice greenery. And then also we have the sun. Is it coming down? Is it on the way up? You know, so to me, that looks like we're looking at the evening time. That looks like, you know, sunset, but, you know, I'm open to having a discussion on that point. I'm open to disagreement on that. Now, having set the scene there in terms of imagery, let's set the scene in terms of the paper, or at least the title of this talk and my presentation today. Fundamentally, tax authorities are under an obligation to collect taxes due. That is just a fundamental responsibility. But, you know, how should they go about that task? And who should decide on how that task is performed? I'll submit as part of this presentation, and just generally, that there is no universal answer to these questions and that they're necessarily contested. So we cannot get agreement as to how we answer those questions. I put that one there, I'll just drop that and we'll pick it back up later on. So how should you go about doing so, and who should decide on how the task is performed? Well, we get this lovely statement from Lord Wilson in the United Kingdom Supreme Court in a case known as Gaines Cooper, where he said that HMRC, the UK's tax authority, is entitled to apply a cost-benefit analysis to how it goes about collecting taxes due. So Judith Friedman, who we're going to hear from again later on, and Professor John Vella, newly anointed at the University of Oxford, they took that proposition from Lord Wilson, and in an article they asked, well, if Parliament then were to introduce a tax which raised a low amount of revenue but was expensive to collect, would HMRC be justified in overlooking its collection in order to concentrate efforts on other taxes if the overall result would be higher overall revenue? So what they've done there is they've just kind of taken what Lord Wilson said to its logical conclusion. So Lord Wilson said that HMRC can decide upon how it wants to collect certain taxes, and if certain taxes are expensive to collect, then presumably that means that HMRC can instead focus its resources on other taxes. But what Friedman and Vella have done there is they've highlighted the inappropriateness of that particular approach. Now, we know that HMRC and other tax authorities cannot deliberately ignore the collection of certain taxes. We know that. But a similar result can be achieved indirectly through allocating resources towards the collection of one tax and away from the collection of other taxes. So on the final point that I have on this slide, I say that, well, while tax authorities cannot pick and choose the taxes they collect, choices can be made as to how to allocate resources to the collection of taxes. So do you want to clamp down on fraud? Do you want to clamp down on avoidance? What kind of avoidance? Do you want to clamp down on evasion? Do you want to direct your resources towards the collection of direct taxes, indirect taxes? Do you want to focus on unincorporated entities, small incorporated entities, large corporates, high net worth individuals? Do you want to focus on particular industries? Do you want to target, footballers in one year, race drivers in another year, TV presenters in another year? Okay, so choices have to be made as to how you want to go about the function of collecting taxes due. And those choices are about how you allocate resources, your limited resources. And these resources aren't necessarily limited. There are only so many hours in the day. There are only so many pounds that you can invest. There are only so many people that are qualified and expert enough to investigate the tax affairs of others. So choices must be made. Let me try and move on to the next slide. Now, the thing is, you can either do that implicitly or explicitly. You can either set priorities which will dictate how you allocate resources and what choices you make, or you can simply implicitly set these priorities. And you'll implicitly set the priorities by allocating resources one way or the other. So as a result, it is better to be upfront about what you're doing. It is better to be able to demonstrate to the public what exactly you're focusing upon and why. And to the credit of UK tax authority HMRC, HMRC does actually set out its 3 strategic objectives, its 3 priorities. And we already heard about this earlier from George Turner, who gave us a very, very stimulating talk about this in far greater detail than I'm going to get into. So HMRC has 3 priorities: to collect revenue due and bear down on avoidance and evasion, to transform tax and payments for our customers, to design and deliver a professional, efficient, and engaged organization. So these are the priorities. And then, as George Turner pointed out to us earlier, there's much more then that's in HMRC's single departmental plan as to how it determines whether it's hitting these priorities, whether it's hitting these objectives. So there's a whole bunch of key performance indicators that guide HMRC's allocation of resources. So credit where credit's due, HMRC is at least transparent about how it does this. But one of the problems is that there's silence on what you do when these objectives clash. What happens where you have a costly initiative to clamp down on evasion. That necessarily comes at a cost to collecting other taxes. So how do you actually determine whether to go with the cost of the evasion initiative, or to continue collecting taxes as you previously were, allocating resources to different initiatives? And HMRC's single departmental plan is silent on that point. And we can contrast then with what the NHS does. For those of you that aren't from the UK, the NHS is the UK's public health authority. Now, the NHS has an ethical framework that is published online. It was published in 2013, is currently being revised, in which 15 core principles are set out, and the core principles determine then the allocation of resources within the NHS. And where there are clashes between these core principles, the NHS has set out 15 key factors for assessing the relative priorities of competing needs. So what to do where there are clashes. So kudos to HMRC on being explicit about its priorities. You know, there's some work to be done in terms of explaining how you resolve disputes or how you resolve conflicts between different factors. The core point that I want to take away from this slide, our core lesson number 1, is that priorities must be set. Priorities as to how you go about the collection of taxes due must be set. But these priorities are not value neutral. I'm actually going to take a quick pause in my presentation here, and I'm going to leave it to the chat. I'm going to give you 1 minute to identify who these 3 philosophers are on this slide. Although one person who shouldn't bother is Hans Gribno, Professor Gribno. I know that you already know who these people are, so I'm not going to give you a prize if you answer anything in the chat. But everybody else, I'll give you 1 minute to tell me who exactly is on that slide there. And I'm going to have a sip of my tea. Whoops. Okay, thank you very much. I can't actually get the chat up, so I'm just going to assume that you all got the answers. On the left-hand side, we have Immanuel Kant. On the far right, we have, that's an interesting place to put him, but on the far right here, we have Jeremy Bentham. Jeremy Bentham in his weird little box up at University College London. And then right down the middle, again, an odd place to put him, we've got John Rawls. So these 3 philosophers had different approaches to determining what is good in life. They have different approaches to moral ethics. Famously, Kant, we have got the Kantian approach, the categorical imperative. I must do what is my duty. So trying to apply this to allocation of resources within tax authorities, we might get something that focuses upon human dignity. So resources should be allocated to ensure that taxpayers are equipped with the right information that they need to go about paying their taxes. A Rawlsian approach would be egalitarian, so it might focus upon allocating resources to the least well-off in society. And we see initiatives like that in the US, where we see investment in tax clinics that assist low-income taxpayers. Or we might go with the Benthamite approach. We know Bentham was all about utilitarianism, whatever brings the most amount of happiness, whatever brings the most amount of utility. And we see strands of Benthamite thinking amongst tax authorities that focus upon maximizing revenues due. So George Turner mentioned that this previously was one of HMRC's strategic objectives. They changed that in the summer of 2019, but it was to maximize revenues due. Now, there's 2 things that I want to get away from this slide. The first thing is, you know, when we set priorities, they are not value neutral. And these 3 philosophers, they give us 3 different approaches as to what priorities you ought to set within, you know, a tax administration. So they're not value neutral. But there's also a deeper point about this, which is you cannot agree. These 3 people, they have entirely different approaches. And there is an open question as to whether, as a matter of, you know, moral truth, any one of them was correct. But in the real world, you're never going to get agreement amongst everybody in society as to which one of these approaches is best, as to which one of these people gives us the best guidance on how we ought to live our lives and what ought to be our ethical code. There will be no universal agreement about values. And to that end, there's not going to be universal agreement as to the correct allocation of resources when it comes to the collection of taxes due. So there's not going to be universal agreement as to what the priorities ought to be. Okay, so that's not great. We can't get agreement on that. Could we get agreement on determining who should set those priorities? So should it be the legislature? Should the legislature set tax authority priorities? And we get this in New Zealand. New Zealand has set out in Section 6A of the Taxes Administration Act how, at a broad level, priorities ought to be set within tax administrations. It is the duty of the commissioner to collect over time the highest net revenue, Bentham thinking, the highest net revenue that is practicable within the law, having regard to the resources available, the importance of promoting compliance, and compliance costs. Or we could leave it to the legislature, as has occurred in the UK. So Her Majesty's Treasury, the Treasury Department, and HMRC together set the single departmental plan and set the priorities for tax administration. The key thing to recognize about these different approaches is that they're both grounded in particular conceptions of the legitimacy of political authority. By allocating responsibility for determining priorities to the legislature, that reflects the participation model of legitimacy, whereby it's legitimate to exercise political authority here because we as citizens and as voters, we get to determine who are our representatives, who in turn then set the priorities. So there's that democratic participation going on. With the executive determining the priorities, that is a model of delegation legitimacy. So we as a society, we have delegated responsibility of over this task to a body that's well placed to look after our interests. So, granted, it assumes that they know how to look after our interests, but anyway, that is the delegation model, which is we trust them because they're well placed to look after our interests. And critically, because these two approaches are grounded in different conceptions of legitimacy, I've got this picture of Rudyard Kipling up there on the right-hand side. Never the twain shall meet. They're simply different approaches, and you will not find agreement as to which approach is correct. You'll not find universal agreement as to which approach is correct. So if we can't find agreement on what the priorities should be, and we can't find agreement on who should set the priorities, then perhaps we can find agreement as to how the priorities should be set. And that's ultimately the point that I'm trying to drag out of this presentation at 5:30 on a Tuesday evening. So the process by which decisions ought to be made presents an opportunity to legitimize priority setting. This has been done in the field of public health ethics. And it's been done in the field of public health ethics through the adoption of accountability for reasonableness frameworks. Now, the accountability for reasonable framework was famously first put forward by Daniels and Sabin in 1998. And with this accountability for reasonableness framework, it can allow us to agree what is fair and legitimate. There are 4 components to the accountability for reasonableness framework. The first is that there should be publicly accessible reasons for decisions. So if we take the example of HMRC's strategic objectives and its priorities, We do actually have publicly available reasons for HMRC's decisions as to how it allocates resources. So that box is ticked, although is lacking in the sense that we don't have clarity as to how you resolve conflicts between different priorities. But in any event, it ticked, at least on the superficial level, has been ticked. The reasons that are provided for resource allocation decisions must be reasonable to fair-minded people. I'm adopting the language there of the authors. Fair-minded meaning people who in principle seek to cooperate with others on terms that are mutually justifiable. Now, of course, I appreciate that that sentence itself is heavily value-laden, but what it's trying to just do is differentiate between those reasons that people generally would regard as relevant. It's trying to differentiate those from those reasons that people would not regard as relevant. Okay, so it's just about having some kind of, some kind of grouping of the reasons that are regarded as good reasons for making decisions. And the relative weight that's applied to those reasons, that's where we might disagree. But generally, we should be able to agree, or reasonable people could agree, about those reasons that can be taken into account. So have we managed to satisfy that in the case of HMRC's strategic priorities? I think that that also has been satisfied. Again, it doesn't matter if you actually agree with the approach itself, but whether you agree that it is a reasonable approach that can be adopted. The third thing is that there should be mechanisms for challenging and revisiting decisions. Okay, so there should be some kind of an established mechanism for determining whether, for challenging the allocation of resources, and then the possibility that those resource allocation decisions can be revisited. Now, with the case of HMRC, there are mechanisms available, but there is no established mechanism, or at least no invigorated established mechanism. Perhaps that can, we could look at avenues that ought to function in that way in the UK, and try to reinvigorate them, such as the Public Accounts Committee or something like that. And the final thing is that there should be regulation to ensure these three conditions are in fact met. And it doesn't matter where that regulation is coming from, whether it's legislation, soft law, doesn't matter whether the regulator is the public, whether it's the, whether it's Parliament, whether it is another branch of government, whether it's some other public agency, doesn't matter. Just what needs to be determined is that there's some effective regulation to ensure that these three criteria are met. So that's all I wanted to say this evening. A couple of lessons to take away. One, you have to set priorities. And in doing so, it's good to make clear what your decision-making process is. Second thing, whatever priorities you do set will not be value neutral. They will reflect particular values. Those values will never get universal agreement. You need to make a decision about who ought to set those priorities. But again, we're not going to find universal agreement as to what the appropriate forum for determining the priorities will be. So perhaps the answer lies in an accountability for reasonableness framework. Thank you very much. I'll attempt to stop share now, and I'm more than happy to answer any questions that you may have.
Stephen, thank you very much indeed. Fascinating presentation, and quite thought-provoking, really, for at least for me, for an economist. I see there's a question through the chat box. So let me read it out, because I know you can't see that. Great talk, Stephen. Just a question: the UK's delegation legitimacy (parenthesis) model. How does this fit in the idea of sovereignty of Parliament?
Yeah, sure. I've got no problem with answering that question straight off the bat. Yeah, so sovereignty of Parliament in the UK, Parliament is ultimately supposed to be the decider of issues, but it can decide to delegate certain functions. So, Parliament has actually delegated this responsibility by having legislation that sets out what HMRC is supposed to do. So it sets out HMRC's responsibility being to collect and manage taxes due. But the legislation leaves open the question as to how you go about doing that. So that's how the delegation model there fits with parliamentary sovereignty. So Parliament itself has determined that HMRC and the Treasury can determine how to set priorities.
Hans, would you like to come back to that, or you need to unmute yourself?
But I think you need to make him a presenter in order to unmute him.
I should be able to do it, but okay. While Hans is trying to do that, there's a question from David. Is it better for Parliament to delegate rather than have the Public Accounts Committee putting on a circus?
Yeah, I mean, I'm much more happy to answer that question, because God knows Hans Gribno was going to put me through my paces there, so that's much easier. Isn't it better for Parliament to delegate rather than have the Public Accounts Committee putting on a circus? So this is presumably referring to the events relating to Anthony Inglese back in 2011, 2012, where the Public Accounts Committee made the man swear in a Bible, and he continued to act as he was. He continued to refuse to answer their questions, citing confidentiality, for which he was actually, eventually his response was upheld by the Supreme Court as the correct response. But in any event, at the time, the Public Accounts Committee threatened Anthony Inglese with contempt of Parliament, I think, the sanction for that being that you'd go off to the Tower of London or something absolutely mad like that. So there are, and multinational entities as well. Yeah, so Margaret Hodge had also put the, I suppose, some of the management figures in multinationals through the paces. One of the issues is that the Public Accounts Committee hearings, they are held on Parliament TV, and so they can be picked up by the media, and then politicians will use particular strategies in order to get their point across to the media. So you do have that inherent problem as to how politics works. So you do get some things, you can call it a circus. It's just another way of politicians do their job, unfortunately. Mm-hmm. Now, one of the things that we can do is we can just equip the Public Accounts Committee with the right tools. We can inform the Public Accounts Committee as to how it ought to act. And, maybe through that process, we can, reinvigorate a different way of approaching politics. But I'll accept the point that as it currently operates, there can be a temptation to court the media and catch the headlines.
Hans, I believe now you're unmuted. Would you like to come in?
Thank you, Christos. Well, Stephen, I wondered, but maybe it's put on the backside of your slides, but I wondered that you did not refer to, let's say, the concept of managerial discretion as you have it in your famous book. So how come?
Okay, so I didn't, so in my book, Tax Authority Advice on the Public with Hart Publishing, published just this year, I do discuss this in terms of managerial discretion, in the sense that HMRC has this discretion to determine how to allocate resources. But the thing is, not appropriate to talk about that managerial discretion if you're talking more broadly about tax authorities, because as we've seen in the case of New Zealand, it's not up to the New Zealand tax authority to determine how to go about collecting taxes. Those priorities have been set by the legislature. And so for that reason, I just avoid using the word managerial discretion there, because it doesn't equally apply to all tax authorities. Now, of course, there has to still be some choices, and there's room for choices to be made, but it's just not as strong in New Zealand and other countries as it is in the case of the United Kingdom. So that's all, just in terms of not confusing people, I've decided not to use the word managerial, the phrase managerial discretion.
Stephen, there are a couple of thoughts in the chat box. Can you see them? I can read them out.
No, I'll try and read them real quick. I've got from from James Oliver James.
Yeah, James Oliver, yes.
James Oliver, Oliver James.
James Oliver.
James Oliver, apologies. A delegation as a follow-up. HMRC is a non-ministerial department with board and commission. So a particular form delegation by Parliament to a department headed by a minister, for example, non-executive. What's on the execution? Many areas of UK central government administration. So the thing is, that is the way that I used to think that HMRC had a lot of autonomy. But it turns out that the Treasury does control an awful lot of what HMRC does. So the Treasury can either do so directly by issuing directions, and those directions are actually binding, or it can direct what HMRC can do through its allocation of resources. And so, the Treasury supplies HMRC with cash money for its budget, and it can set, particular requirements on how that money is actually spent. So it doesn't actually have as much autonomy as I previously thought. But you do have issues around accountability in that it is a non-ministerial departmental body. So it doesn't have a minister. You don't have parliamentary accountability. You can only exercise accountability then through things like the Public Accounts Committee. So, some people in the audience might not like what the Public Accounts Committee does, but that is the framework that we actually have in the first place. The second question, how far do you think it has been accepted or adopted in practice across all? Are there any operational constraints therein? So with the reasonableness framework, the accountability for reasonableness framework, I'm not trying to say that this isn't adopted in different countries and it ought to be adopted. I was actually just trying with this presentation to set out the criteria for an accountability for reasonableness framework. And, I leave to all of you to determine whether those criteria have actually been satisfied in your own jurisdiction.
Thank you. I'm afraid I have to stop you here, and also I have to correct myself. It's not James Oliver. It's Oliver James, and I apologize to Oliver. Thank you. Thank you very much, Stephen. But time is run out, and we need to move on. Thank you. Fascinating discussion and presentation. Thank you.